Sahib, Raman, Milin, seniors, fellow members, ladies and gentlemen, very good evening and a warm welcome to you all. Friends, today's topic, the transfer pricing law was enacted by the Finance Act 2001 with effect from 1st April 2002. So in a way, in 2015, this transfer pricing regulations will acquire teenage as far as India is concerned. In last 12 years or so, there have been over 35 amendments and several other to the sections itself, plus several amendments to the rules. In his speech in 2001, the then finance minister introduced the transfer pricing provisions as relating to computation of income from international transactions having regard to the arm's length price in respect of the associated enterprise. Now, the department argues that the transfer pricing provisions are not just the computational provisions, but Chapter 10 of the Act is a complete code by itself and not just mere machinery provision for computation of ALP. And therefore, the department's argument is that the charging section is inherent in the Chapter 10 of the Act. I understand that the disputed transfer pricing additions now run into several $1 billion, and TP would update us on that. And the quantum of addition probably nearly matches India's fiscal deficit. So a measure, transfer pricing is usually considered as a measure to protect the tax base of the country, is now being converted into a revenue-raising measure with extreme positions and high-pitched assessments that are now being dubbed as tax terrorism. The Bombay High Court recently, in the case of Vodafone 3, confirmed that Chapter 10 is merely a machinery provision to arrive at ALP. It cannot be a charging section. The substantive charging provisions remain what they are, Section 4, 5, and under various heads. So in this scenario, it is important that we have to, so the court said that even income arising from international transaction first must satisfy the test of income. So the transfer pricing law and regulations are now abounding with various issues and controversies. Add to that the specified domestic transaction will, I don't know where we will, it will take us to in terms of issues and controversies. I recall Dastur Sahib in his budget speech in the year in which the specified domestic transaction was introduced, described these provisions as, being bandar ke haath mein ustra. If I recall in his classic Parsi style humor. Today I'm sure Ostwal Sahib will be covering a lot of ground, and I don't intend to elaborate further and stand longer between him and the eager audience. In terms of introducing Ostwal Sahib, I don't even need to say that he needs no introduction to this enlightened audience. However, let me just put this for the sake of completeness and highlight some of his accomplishment. The first introduction I would like to give him is he is definitely an associated enterprise as far as Bombay Chartered Accountant Society as well as all of us professionals are concerned, because he receives us with open arms and does not maintain any arm's length distance. He's a rank holder in CA Final. He's been member of numerous committees, not just locally in India, but internationally. He was member of the CID TAG, Technical Advisory Group of OECD Paris. He is member of Business and Industry Advisory Committee, BIAC of OECD Paris. He is Vice President of International Fiscal Association, Netherlands, and he co-chaired the recently successfully concluded IFA Congress in Mumbai. He is also chairman of IFA India branch. He was member of Emerging Issue Task Force on Non-Resident Taxation formed by Ministry of Finance. He was member of Finance Subgroup of Construction Industry Development Council of Planning Commission. He was member of Expert Committee formed by CBDT for framing transfer pricing regulations. So in fact, the transfer pricing regulations as were enacted, Ostwal Sahib played. He's represented India on numerous international conferences, and he's been a prolific speaker and writer. I think you will all agree that Ostwal Sahib is definitely, when it comes to sharing his knowledge, does not maintain any arm's length distance. And before I invite him to address us, I request Raman to felicitate him with a token of our appreciation and gratitude. Ostwal Sahib.
President, Mr. my dear friend, I would not name him, distinguished seniors in the profession, ladies and gentlemen. I was indeed taken aback when he called me, Nitin called me saying that you have to speak on transfer pricing provisions. I said the provisions are already there in existence for last 15 years. He said, no, something important has come in Vodafone. So therefore we should think about this doing the lecture again. I said, fine, no issue. Transfer pricing provisions were introduced in 2001, and I was one of the authors of the regulation who drafted this regulation originally. There is no two view on that, because I don't want to disown that, whatever criticism you have on the regulation, with a good intention. But as Dastur Sahib said rightly, बंदर के हाथ में उस्तरा दे दिया तो क्या होगा उसका? So the effect is like that. The law exists in India, keeping in mind the provisions of Indian requirement based on the international practices. The origin of transfer pricing regulation starts with OECD 1995 guidelines. As far as the codified regulation in the world is concerned, but there was a transfer pricing regulation even prior to that in India, but not known as transfer pricing per se. Section 92 did exist in Section 42 did exist in 1922 Act. There were loose ends of that section. Number of concepts were not defined. So also we had US regulation, which was very extensive, which was enacted in 80s. The OECD took birth from US regulation. And then the world took the leaf from the OECD regulations to enact the transfer pricing regulations in their respective jurisdictions. The developing countries took a little longer to do that, but I would not blame any developing country, because Korea was one of the first to develop immediately after OECD came in 96. 95 was OECD, 96 was a Korean regulation. Very quick. And they were really an answer to the OECD's development. How the developing country should react. Because there were a lot of loose ends in the OECD regulation. Korea tightened it. China and India followed Korea. So we did it in 2001. So we also did it in fairly reasonable time, 6 years. When we had the regulation, intention was the apple should look as an apple, should be called as an apple world over. That was the whole intention. But the controversy is our profession, our business. And as an Indian, the Constitution of India starts with the first letter, Bharat, the India, two meaning. So everything has two meaning in India. So the revenue officers took it to logical conclusion, illogical conclusions, whatever you say it is. But that gave you big business. So these controversies became an important tool of dispute and differences, and we are here going to deal with some of them, important of them. This is a subject where you can speak for hours. Because India is one country where the litigation on transfer pricing is equivalent to 80% of the litigation on transfer pricing in the world. Rest of the world, 20%. And there are reasons to do that. We have no settlement mechanism. We have to, CYA principle we follow. The revenue officer says if the High Court says something, we will accept, possibly. Supreme Court says yes, we would like to litigate, otherwise C and AG will cast aspersions on our conduct. So such attitude, if exists in this country, the attitude does result into a litigation. But let's hope with the new government coming in, some rational thinking could prevail. I had an occasion to discuss this Vodafone decision with the revenue officers in Delhi. Prima facie, the discussion really, they feel heart to heart, this decision should be accepted. And they should not litigate to the Supreme Court. But thing as it may stand, the officers may feel it is okay, but one doesn't know what will be the state today till the board takes a final decision and communicates to the public. The reality of the life is this is a decision worth accepting, is a conclusion. And I will come to the rationale little later. I will explain the decision. The topic which we have divided is recent issues, recent trends in the transfer pricing, key issues on international transfer pricing, the major issues which you have seen, the amendments which have taken place in 2014. Some of the highlights of the amendments are very useful for us because the finance minister, with the change in the government, has come out favorably on some of the aspects, particularly when he moved the amendment to the finance bill at the end of July. At that time he did mention about the transfer pricing amendments. Some of the amendments were hurriedly referred to in the budget, but they were not incorporated in the act. But subsequently some of the amendments were changed in the amendment bill, which was placed again in the July end. And some of the intents were made clear because there are some of the legislations will be implemented through the delegated legislations, that is rule-making authority. Also, he did mention in his budget speech, while moving the amendment to the finance bill, that there are hiccups which have been created in the domestic transfer pricing. I am conscious about the fact, and necessary simplification measures will be undertaken. In fact, the whole note which was running into 3 pages, which was lying with him, he simplified just by way of one sentence, and possibly the actions are on the subject, and I wish by this time the board ought to have clarified those issues which have already been approved by the finance minister. But as you know that in India, today the board has only one member and one chairman. There are 2 members, the sanction post is 7. I don't know whether it is an austerity measure, whether it is by design or is by accident. But the reality is, board is functioning with 3 members for last 3 months. Now 2 members, one is chairman and 1 member. How do you expect them to take up so many issues of such a size of country which we are talking about? So these are the issues. The amendment particularly which talks about the deemed international transactions, which is a very vital, one has to take care of that amendment, section 92B2, and the implication of that. If you are filing your return of income electronically, there are some difficulties which you have. Also you need to understand that. I don't file, but I am told that these are the difficulties, so I will just try to explain those. Multi-year data concept and the range concept which has been introduced in this finance bill, as by way of a reference, nothing thereafter has happened. But if that comes in, at least in my personal opinion, 50% of the litigation on the transfer pricing should come to an end. And therefore, this is one of the sore issue. How do you use the data available in the public domain? So far, our guidance is the average has to be taken, which is unique. In fact, if you look at the Indian regulations, they are different from the world. Our regulation talks of take the mean, arithmetic mean. Nowhere in the world it is arithmetic mean. It is interquartile range. Now we are talking about the multi-year data with an interquartile which has not yet been notified, which will, these two amendments in the transfer pricing regulation possibly will make the life simpler as far as the day-to-day implementation of transfer pricing regulation is concerned. Other hiccups would, of course, like Vodafone, etc., would continue. All those issues, if they are not accepted and not resolved. We have some good news and bad news as well. We have a Delhi tribunal decision in the case of LG, which uses the bright line test. Where from they got the bright line, God only knows. Indian regulation doesn't permit that, but they copied it from the US regulation, and they said bright line test should be seen. We have recent decision of another Delhi tribunal, that is Japanese company Mitsubishi, where it was Berry ratio was used, and it was favorable to the taxpayer, and therefore taxpayer is saying this kudos, excellent. This is an international practice. But honestly speaking, if you ask me my views, the person, Mr. Berry, who created this ratio, gross profit upon the turnover or overhead, all expenses, he himself is against the principle of using Berry ratio in the transfer pricing regulation. In his own article, he has written that. Nevertheless, it is favorable decision, so therefore we can celebrate saying that it's a good decision, and we must accept that. We have regulations on the advanced pricing arrangement which were introduced 2 years before. People really found this to be very useful. Number of companies have gone for making an application for advanced pricing arrangement. It is akin to the advance ruling under the income tax, international taxes. Similarly, a transaction which you enter into with an associated enterprise, if it is to be approved by the government in advance, then once this is approved in advance for 5 years next down the line, this transaction, if the fact and circumstances remaining same, there is no change in the fact pattern, then the transfer pricing provisions gets relaxed. Lot of requirements gets dispensed with. So this was one of the major relief lot of companies opted for. But unfortunately, the advanced pricing arrangement in our country, the way in which it has gone, is again an interesting anecdote. You see, episode, because you see we have the two type of advanced pricing arrangement. One is unilateral and second is a bilateral. The clarification on the subject of bilateral advanced pricing arrangement, when you talk to the authorities, there are some issues which are really a genuinely pain in the neck, and they are not getting resolved. So far we have undertaken some of the advanced pricing arrangements which are unilateral, and unilateral can be undertaken domestically without any reference to the other country's competent authority. But frankly speaking, if the unilateral advanced pricing arrangements are accepted and you are required to pay some taxes here on account of that arrangement, which the other country does not accept that it is a tax payable correctly in India, they may deny you the tax credit of the taxes having paid here, and that becomes a sore issue. And therefore bilateral is the best advanced pricing arrangement, where the two competent authorities come into the picture. We had good news that the person who was making very adamantly decision making on this transfer pricing, bilateral, unilateral, as the case may be, our competent authority, who was unceremoniously was immediately removed from his position a year before by the minister, and because of the various circumstances and reasons, and the new competent authority came in, he is more reasonable and more docile, and he is ready to listen to you. The good news. And therefore these are the factors which are very relevant for the purpose of taking a decision whether should we pursue the APA or not to pursue the APA. We have got new powers which have been granted to the transfer pricing officers to levy the penalties, which are really draconian. Earlier powers were there with the assessing officer and with the CIT, but now they say even TPO can. So therefore the powers have been given to the TPO. But I can understand, you give power to the TPO, then why do you want to give the power, similar power to the assessing officer and the CIT? Remove those powers from them. Give the power to the one person. Otherwise you are subjected to the harassment at all the three levels. And that is what one sore issue which continues. Safe harbor provisions have been introduced to simplify the transfer pricing provisions. Honestly speaking, they are they are nowhere near safe harbor. The safe harbor, the so-called safe harbor regulations which have been introduced in India are absolutely worked out in such a stupid manner, such a manner that it is impossible for anybody to use those safe harbors. Internationally, it has become a laughing stock. And I'm told, very interestingly, the experience shows the persons who have drafted the safe harbor regulations and the committee of that people, they tell us it is intentionally done it like this so that you can come for APA. To make the APA successful, we have created a draconian safe harbor rule. How can you do that? This is really a waste of time of the professionals, and the whole country becomes a laughing stock in the world. You want to have 30% profit on the research and development activities undertaken in India. But if this is a 30% profit everywhere world is making, you should ask for 30%. I'm not saying. So empirical evidence you give it that the world over this is the profitability, and people want to shift their R&D activities here, they also should pay 30% profit. I'm not in favor or against, but the way in which it is implemented, honestly, one by one, when we see that, we will come to know the issues which are not acceptable to the people on safe harbor. Then it comes to the last is the domestic transfer pricing. Time permitting, I will take you through, and there are some international developments, important international development. You had yesterday, possibly, or yesterday or day before yesterday, the OECD came out with a intra-group services transfer pricing paper, which says what should be the margin and low cost services which are undertaken between two associated enterprises, how the transfer pricing provisions should deal with, how the transfer pricing provisions will apply. Friends, let me tell you very frankly, OECD's all these draft documents are one-sided documents. They create these documents mainly with a view to see that the developed countries do not face the difficulties in the developing countries. The developing countries are becoming more aggressive. In fact, we are one of the most aggressive countries, none other than Brazil. Brazil was one of the draconian countries for doing transfer pricing regulation. The safe harbor margin there, it used to be 60% profit, which is known as a fixed margin method, which is akin to safe harbor, and which they reduced it to 30%. Now, if you want to do a transaction with a Brazilian associated enterprise, and if you are in the goods, the services, there is no clarity. If you are in the segment of sale of goods or import of goods in Brazil, they expect you to make a minimum 30% profit on the goods which you have imported from associated enterprise. So therefore, and they don't understand any other method, that transactional net margin method, profit split method, cost plus, the resale price method, nothing doing, only one method. This is our cup method, this is cost plus method. Both are one and the same. Then we call this to be a fixed margin method. And somebody challenged them saying that, sir, how did you come out with a fixed margin method? They says, this is our internal study which we have undertaken. I said, can you give the data of those study which you have undertaken? Sorry, this is not available. But there is nothing available. And that is what the problems are. So these are the problems which we are now faced with these all issues. We need to understand what are the important changes which have taken place in the transfer pricing. Basic provisions I don't intend to deal with, because all of you are now 15 years of experience. You all know what transfer pricing is. Now, it is not the case in the first lecture when I gave an example, when the Commissioner of Income Tax asked me, sir, what is this transfer pricing committee set up for? I was member of that committee. He was under the impression, paisa to roz diya jata hai, liya jata hai. Transfer pricing is it meant for that giving money and arm's length money should be paid? Ready reckoner rate. I said, no, the transfer pricing as you have understood and as I have in my concept are different. So I had to do a labor of explaining what transfer pricing is. But those are the days which have gone. Now today we are quite, almost matured on the legal provisions and how to implement transfer pricing, and therefore we need to understand what transfer pricing stands for. I'll first of all deal with the amendments which have been made in the finance bill. The first amendment is about the rollback provisions of the advanced pricing arrangement, which are one of the important and useful provision which should be saluted. The country has really gone by a concept which, internationally some of the countries do have. Then strengthening the administrative setup of APA. It was already told to us. The advanced pricing arrangement now will be set up. Benches or the separate units will be set up in India at Bombay, Bangalore, Mumbai, Delhi and Bangalore. Nothing of that sort I have seen so far happened, but sooner or later it has to happen. So that is one important change. We will take you through everything. Introduction of range concept I already said about, and multiple year data I have already said about. Changes in the definition of the terms deemed international transactions, most dangerous thing which we have to also understand, and penalty, etc., etc. Can I just get a water, please? As you said, transfer pricing provisions world over are a problem. It is not the case that it is a problem only in India. Every multinational company faces transfer pricing issues. Developing countries are taking more aggressive position now because developed countries did take that position in the earlier years. With a view to resolve these problems, OECD has also come out with some conceptual changes, and they are talking about in the name of BEPS. Base erosion and profit shifting. There are three actions 7, 8, 9, which are dealing with transfer pricing provisions. And the world after 2017, when we will meet again, you will realize what transfer pricing we are talking today and what transfer pricing in 2017 would be totally different. The OECD is now talking about creating the country by country reports. Every country, every taxpayer will have to make a disclosure of so many additional information which will be shared between the revenue officers. How many employees you have got, what is the asset base you have got, what are the functions you carried out, and all those will be shared with the country by country. These are the issues which we need to keep in mind what is happening in the world. And they are also wanting to create simplification. When United Nations started creating transfer pricing, the guidelines for the developing countries, the OECD realized that their regulations are not up to the standard. They are not clarifying anything. They have some difficulties, and possibly because of that, even the OECD started working out the new changes in the transfer pricing, which we will see possibly in 2016 and 17. A report has already been released, one report, draft report. If you wish to make comments on that draft report, you can access the OECD website and make suggestions on what the transfer pricing should be on intra-group services. Economic downturn of the world has really created these new challenges. The developed countries now started getting more revenues, and these are the reactions arising on account of that. Plus, the development world over is, we must be aware of those developments. FATCA. I spoke about FATCA a year and a half before. People said, what is this FATCA? We do not know. It's like FATCA. So all sort of things. But FATCA today has in place foreign accounts, the compliance requirement of the USA. If you are a US citizen, you are resident, you are green card holder of the USA, no bank, no financial institution, no broker will be able to deal with you without themselves first of all registering with the American authorities and then making disclosure of your details to the American government, and withholding tax requirement. If you don't comply with that, then you will be slapped with the penalty of 30% withholding tax on all the payments going to you from the USA. And that is one of the important draconian regulation. The government of India was resisting this regulation for last 3 years. Ultimately, we have signed intergovernmental agreement, possibly after registration with the US regulators by obtaining the GIN number. We need to give our details to the Indian regulators. Their separate cell has been created in Delhi, and they in turn will send the details to the American authority, and therefore it would be a good practice to have knowledge on the international development on FATCA, so that the clients who are dealing with the non-residents will have to take care about that. And finally, we come to the recent trend. As you know, our chairman or president has already spoken about the transfer pricing adjustments which have been made. The last year, the maximum adjustments were made was 70,000 crore. This year was around 65,000 crore rupees. And that is a huge, as if it is a revenue measure. You know, transfer pricing was introduced with a view to have an anti-avoidance measures. It is the provisions which were akin to anti-avoidance, so that you can curb the practices of evasion or avoidance. Whereas now this has become revenue measures in the world, and in India particularly. And therefore, this is a huge transfer pricing adjustment, not even thought of, not even contemplated. Now, what are the key challenges? Key challenges which we have to see in the transactions of the different type, which are we are going to have. The key challenges is what is that? The transactions related to shares, marketing intangibles, royalty payouts, management charges, single year data, multi-year data, IT or IT-enabled services, loan and guarantee fees. These are the major challenges apart from the routine transactions, which are also subject matter of challenge, which is there. I think the transfer pricing has not left any single area of challenge. The way back in 2002 or 3, when Bombay Chartered Accountants Society published the document, published the manual on transfer pricing, we had contemplated and we had given enough guidance on the on such type of transactions in our manual. We were the first in India to give this guidance on international transactions related to share capital. We felt that this is also capital, possibly transactions. You should make up appropriate disclosure. If it is not a transactions, at least make a disclosure so that you will have no difficulties meeting with these issues in your assessment. And people have followed those practices. Now the latest decision of the Bombay High Court, Vodafone. What was this matter? Why this transaction? And not only the Vodafone, there are 27 different companies which were subject matter of transfer pricing assessment in this particular year, which are subject matter of pending challenges in the court. What was the transaction? There was a company, Vodafone. Vodafone is now does not require any introduction. They are in the business of litigation rather than in telecommunication. This is Vodafone number 3. Number 1, number 2, all of you know. Here was a case, Vodafone subscribed to their existing subsidiary, which was doing a BPO company for telecommunication company, which was their 100% subsidiary. And they needed a capital, because you need an expansion of the business, you need a capital. They valued the share because as per the Reserve Bank of India's guidelines required, DCF method was done, and they subscribed to that capital of that company at that rate. Despite the fact that this was 100% subsidiary company, they could have taken huge number of shares by way of just giving the shares at par value, but they did subscribe at a premium. The department felt that this is not an acceptable premium. Department said we must value it in a way which we want to understand. Benefit test, this and that, all the number of other factors. And the department valued the figure at a very high value. Now, after having valued that figure at a very high value, they said you ought to have brought this capital into the country. Whereas you have brought the capital only in X, you ought to have brought the capital 10X. So 9X which you have not brought into the company is your evasion, and that is your income. When you subscribe the share at a premium, the premium is not your income. But when you do not subscribe the share capital at a premium, the differential premium is your deemed to be an income. I don't understand what from this logic came in. First of all, the Finance Act 2012 was amended in 2012 to bring in number of financing transactions, capital financing transactions to be an international transaction in the definition of international transaction with a retrospective effect. But this is clarificatory. And transactions which are already taken place, you cannot apply retrospectively this law. And therefore, prior to an amendment, international share subscription capital was not an international transaction, was a view taken by the company. But having picked up the transactions, but you know, the companies always, the auditors are cautious sometimes. They create business for themselves so that future litigation can go on. They made a disclosure in Form 3 CEB. Share capital transactions are not international transactions, and therefore we are not following any particular method. And frankly speaking, in a 100% subsidiary company, when you are subscribing to the capital, which method you will apply? Is it a cup? You can't apply because there is no comparable party with whom the shares have been issued. Or is it a cost plus resale price, profit split, or TNNM? I have my own difficulties. And that is the reason I mentioned about the BCA manual. We did mention about this particular aspect in our manual. Genuine difficulties. And therefore, and when the section is not implementable, is not workable, courts in India have taken a view that this section is not applicable in such situation. So similar was the fate here. The fate was, it did not stop here. You ought to have brought 9x as your capital. Having not brought that 9x as a capital, this is your deemed income. So far so good. You ought to have stopped there. No. We assume that you brought 9x and given this as a loan to your parent. And on that loan which you are given, you ought to earn an interest on that. And that also should be made a subject matter of addition. Secondary adjustment, this is called as. I distinctly remember as a member of the committee, we gave a guidance to the government that in India, it is premature to apply secondary adjustments. We do not create we are not recommending secondary adjustment for us because we want the transfer pricing law to be developed. And the suitable amendments will be made, should be made later on once the maturity is achieved. So we are in a nascent stage, do not go for the secondary adjustment. If that was the view taken, legislative intent, if somebody wants to argue it out, the committee for which it was formed did mention a recommendation of that, and necessary amendments were not drafted keeping in mind secondary adjustment. If you have to make a secondary adjustment, the law should authorize you to do that. Look at the legislation of various countries, Korea. Look at China. They have secondary adjustment provisions. And our law was developed much later than their laws. Keeping in mind this aspect, we said no secondary adjustments in India. But this was a case where secondary adjustment was carried out. And that was, the secondary adjustment is that deeming further notional adjustment on account of interest which was made on the amount which was taken as or considered as having been advanced to the associated enterprise. So therefore the issue arises is whether issuance of shares lead to an income to the issuer, and if carried between the associated enterprise, should it attract the transfer pricing regulation? That was an issue. And Bombay High Court said on both the counts in favor of the taxpayer, sorry, it cannot be done. Interestingly, last week we were in United Nations debating the same issue. And Tanzania has created a regulations. They say in such situation, we will assess the Indian company or the Tanzanian company. We'll forget about the foreign company. So every country is harping upon to get some benefit out of these provisions. But at what cost? You're driving your foreign investment, foreign capital, FDI coming into the country, out from the country. The people who are responsible, in fact, I have been on a record saying that the people who have been responsible for creating such an assessment, committee should be set up to find out who are those people, and a punishment should be carried it out. That should be the way we should do the work in this country. It is no doubt that you are appreciating some good work, but the work the courts have taken, it is illegal. When the court says it is illegal, why can't you take an action? And this was the case. Not only that, we stopped there. Next year, the two commissioners in Bombay, we have two DITs, right? One DIT made this adjustment. Next year, the second DIT felt, oh, it was around 8,000 crore rupees adjustment. I should do something better than that. And she said, she made an assessment, approved an assessment on Shell, another company, 15,000 crore addition on account of identical transactions. Share subscription to a 100% loss-making subsidiary of Indian company, whose face value was below market value. face value was, a 10 rupees share was 6 rupees. They subscribed at par value. They said, no, you ought to have subscribed at 185 rupees. And the difference was 15,300 crore is your deemed income. And that was the second case. And in the process, they continued all the cases like this whole year. The story does not stop here. The story has another angle. Look at that angle, very important. Top Securities, a company in India, set up a 100% subsidiary in Belgium, very high tax country. Belgium has a share capital, stamp duty on share capital based on the face value like we have in Mumbai. Not a fixed value or not an exempted. When the company took a decision to subscribe to the capital of that company in euro, they decided to charge a high premium and low capital value. 1 euro or 10 euro share, 267 euro premium. So that, they don't pay stamp duty. The officer took a view here that share capital transactions, they did not only disturb the foreigners, they disturbed Indians also. The officer passed an order, this 267 euro price which you have paid for purchase of one share, 257 euro constitute a loan, 10 euro is the share capital, and therefore you ought to charge an interest on that. And this is also your income, first of all an income, then interest, then charge, all sort of an adjustment in a reverse way. How can you be inconsistent in your principles? Follow the same principles reverse way also. What you have done it for Vodafone. At least you would have been consistent in doing that. Somebody has charged a premium, you have respected that. Here somebody has not charged a premium, you said no, it is your income. And somebody has charged a premium, you said no, I'll ignore the premium. So these are the facts. These are the circumstances in which when we read this order, I was very clear in my mind that it is a clear-cut illegality, nothing but an illegality. So this was a Vodafone's decision, so also the case of Top Securities, which I mentioned is unreported decision so far. So the issue for consideration is, India does not have an express or specific legislation for inflicting the secondary adjustment, and therefore secondary adjustment was also not warranted. You could have stopped at the first level. You could have not said further it is a deemed loan and therefore I make an adjustment. That is again not warranted. That was another issue which I just wanted to draw your attention to. High Court's observations are very interesting. High Court says per se, as Nitin has already explained in his introductory speech, about the nature of transactions. It is not a computation provision. It is the provisions for avoidance. It is their machinery provisions. And certain things which is not an international transaction, not a transaction per se, where is an international transaction, how can you make an adjustment on account of that transaction? So illegality from beginning. That was an issue which is really worth considering, and therefore I believe if the government of India accepts this decision of Bombay High Court, it will be a clear sigh of relief for all foreign investors. How do you structure your transactions? We had the Reserve Bank of India's regulations of valuation of share. Of course, now Reserve Bank of India has dispensed with those regulations, and they say any international best practices can be followed for the purpose of valuation. We don't want to give guidance on the discounted cash flow. I fail to understand why do we really change your philosophy of making all these principal issues so changing so fast, so ambulatory about it. In 2010 we came out with the discounted cash flow method, and 2014 we are abandoning that method. Deemed international transaction is another very important piece of amendment under section 92B2. What this section says, for the purpose of this section, 92B1, which defines international transactions. What it says, when you deal with one of the parties to the associated enterprise, one of the parties to the transaction should be non-resident. It means if both the parties are non-resident, the transaction is an international transaction. If one of the parties to the transaction is a non-resident, it is an international transaction. Which leg is non-resident is not relevant. Either you are purchasing or you are selling. When you purchase the goods, the other party is non-resident. When you are selling the goods, the other party is a non-resident. The Indian party is doing a transaction. This concept was extended to a deemed international transaction under section 92B2, which did not mention anything about the nature of the or residential status of the associated enterprise. Consequently, a transaction entered into between two Indian resident enterprises was not regarded as an international transaction. And that is a fact of the life that was done with this intention as well. While doing that amendment, while drafting the legislation, it was thought fit that there must be some provision to consider deemed international transactions. Say, for example, one of the criteria of associated enterprise in our definition under 92A2 is if you have taken loan from another enterprise and that loan is more than 50% of your the net worth or book value of your all assets. Who will give you more than 50% of the book value of the asset as a loan unless he is an associated enterprise? Or in certain type of transactions, for example, of a high capital value transactions, somebody has financed it, then he should face the consequences of being treated as international transactions for transfer pricing purposes. And there should not be a difficulties, particularly in the airlines companies or shipping industries where huge finance is raised from international lenders and with a view to acquire the assets, because these are a very capital intensive business. In such situations, we have come across the transactions which have been reported to the authorities that international lending bank is considered as associated enterprise and the transactions are reported. Income tax officers have accepted those decisions because an IMF lending the money, you will accept, because there can't be any motive attributed to that. So therefore, there was a possibility of having a deemed international transactions which was required for a third party. So if the third party, which is the terms of the transactions are arranged between you and the third party, which is a non-resident, or arranged between your AE and the third party, then the transactions could be regarded as a deemed international transaction. That was the section 92B2 says. A transaction entered into by an enterprise with a person other than an associated enterprise. The person with whom you are entering into the transaction is not your associated enterprise. Shall, for the purpose of subsection 1, be deemed to be a transaction entered into between the associated enterprises if there exists prior arrangement. If there exists an arrangement or in relation to the relevant transaction between such other person and the associated enterprise, or the term of the relevant transactions are determined in substance between the other person and associated enterprise. So for example, there is a third party here. The associated enterprise is there outside India. Both of them determine the transactions, the terms and conditions of the transactions. Based on that terms and conditions of the transactions, the Indian taxpayer enters into the transaction with the third party, and that Indian taxpayer is the subsidiary or related to the associated enterprise. The transaction becomes a deemed associated enterprise, deemed international transaction because it is a connivance, a sort of a arrangement, a conduit is there. Third party is already predetermined the price. So in such situation, I can understand the transaction can be regarded as an international transaction. But consider the situation given here in this map. The two issues which have come up before Bombay Tribunal, in one case Kodak, and this is case of Swanandra's case, where Andhra Pradesh Tribunal had to consider this issue. Consider this case. IJM is an international company, associated enterprise. It has entered into a joint venture with Andhra Pradesh Housing Board and formed a company in India which is called as IJMII, 51% subsidiary, where Andhra Pradesh government took the 49% shares of that company. And then they have a company which is called as the SWARN, Swan. That other company with whom the IJMII rendered the project management services to the company Swan, pursuant to an agreement between the foreign entity and the Swan. Based on the arrangement entered into by the foreign entity with the Swan, the Indian company entered into a transaction. Both the legs of the transactions were purely in India. And that company happened to be the subsidiary, 49% held by the Andhra Pradesh government. Obviously, no government will allow non-arm's length related transactions. And there the challenge was, the revenue officer took a view, applying the provisions of section 1492B, he says there exists a prior arrangement. But the prior arrangement was merely it was a joint venture agreement. Rest of the agreement of construction contract which was done with an Indian subsidiary was purely done on the terms and conditions. There was no interference, there was no evidence to show that the foreign enterprise has influenced the decision. Even the government of Andhra Pradesh would not allow that to happen. And they said this is deemed to be an international transaction, though it is entered into between the two resident entities. The issue arises for our consideration is whether the transaction between the IJIM India and Swan fall within the definition, within the purview of section 92B2. Answer is clearly no. In my opinion, clearly no. And the question of interposing an independent third parties between the two associated enterprise to avoid transfer pricing applicability, answer is again no. There is no interposing any entity. The transaction was purely a domestic transaction. It was a construction contract which was executed. There was no payment involved to the foreign enterprise at all in this transaction. The Hyderabad tribunal took a very right decision saying that it is not an international transaction, but this government of India felt that this is too much. How can you say that this is not an international transaction? We believe that it ought to be an international transaction, and the law was amended. The law was amended to include the provisions of section, to amend the section 92B to include saying that the transaction, one sec. Yeah. Where the enterprise or the associated enterprise or both of them are non-resident, irrespective of whether such other person is non-resident or not, it will be deemed to be an international transaction. So therefore, you have a non-resident and resident as associated enterprise, and the other person is, whether he is a resident or not resident, we don't care. Earlier example which I gave was a transaction with a non-resident. Now here, irrespective of residential status, whether you are resident or non, the transaction will be deemed to be international transaction, and therefore the compliance will be required to be made. Now the issue arises for consideration is while filing the return of income, when and while issuing the form number 3CB, what sort of a disclosure one has to make? Who is to be considered as related party? If I consider Indian company to be related party, then I will have to disclose that in the details of related party. And if I do so, then it will capture automatically, because only those parties which are related parties, their name can be captured when it comes to the international transactions disclosure in the detailed form. And if you say that Indian party is not my related party, you are by admitting, by yourself, you are making an admission that Indian party is a related party. And by not disclosing, then you can't fill up the remaining part of the form, because in that form it will not be captured. And these are the practical difficulties. The genuine difficulties, there are huge number of difficulties which have come across in filing the return of income. Particularly, sometimes we take a view very aggressively when computing, when giving credit for the foreign taxes. First give tax credit and then calculate surcharge and education cess. the return of income computation does not permit that under the methodology the income tax department has followed while filing the tax return now. So the question is it an intention, legislative intention to cover such transactions also? If that be the case, consider it to be a domestic transfer pricing transaction. How can you consider it to be an international transaction? It is not an international at all. So that was an issue, and similar was a case of a Kodak. Kodak, in the reorganization scheme internationally, they went out of the medical equipment businesses. So they sold all their businesses. American Kodak has sold their business to American Carestream Inc. There might be a global understanding and global arrangement that all the businesses in the respective tax jurisdictions will be sold to the subsidiaries of that company world over, because it is common owner that will only be paying you the full price. But the price computation, methodology of payment, etc. was left to the respective jurisdictions to work it out. The Indian Kodak sold similar their medic equipment business to the Carestream India, based on the valuation report obtained by the independent valuer, based on the transaction agreement which have they entered into with an Indian company, and they said it is not an international transaction, but it was, as assessing officer took a view that it is an international transaction which requires to have been disclosed. Now the issue for our consideration is whether sale of an Indian business by Kodak India to Carestream India is a deemed international transactions from the language which was there in the pre-amendment income tax law section 92B. In my opinion, it was not an international transaction. And the tribunal rightly concluded it is not an international transaction because the transaction is between two resident taxpayers. And that matter came up because of this issue. The amendment took place in the Income Tax Act in 2014. The issue here is, look at this case. If Kodak India or Kodak International had a transaction or arrangement or an agreement with an Carestream India, or reverse way, if Kodak India had the agreement or understanding with Carestream USA, either way, it could have been an international transaction under 92B. But it was not a cross-border transaction at all. It was transaction in the domestic area. Both the companies entering into agreement was Indian companies. Both have signed the business based on the valuation, market value of the business. Nobody would like to take less amount. And out of that money which have been received by Kodak, nothing was paid to Kodak USA. Only the dividend could have been paid. A dividend is always subject to withholding DDT. And that means not withholding, payment of DDT. And that cannot be challenged. And therefore, to consider such transaction as an international transaction when the lawmakers have themselves not envisaged, it doesn't permit that, is illegal. In my opinion, it is unfair. And therefore, I believe these are the two decisions which have been reversed by this amendment of section 92B will have now far-reaching impacts. I do not know if you have a foreign parent and your company is an Indian subsidiary and you are dealing with the DHL in India, and the foreign parent has already arranged with the DHL internationally that all the courier business of this group must be handled by DHL, and the prices are already determined, but they may say the price will be determined based on each jurisdiction, whether this transaction also will be an international transaction. And most of the multinationals do operate on that lines. They use their capacity, the collective bargaining power to enter into the transactions, predetermine the rate at a lower price. They bring down the rates world over. And if that is the case, I would suspect now the implementation of this regulation, the documentation and the reporting which we are doing, to what extent they are correct, are justified or not, is a $1 million issue which will require a reconsideration on the subject. The computer is small, the fonts are small. I have difficulties in reading myself, so therefore please bear with me. Can I get my iPad there? I have an iPad there. Possibly I can read from my iPad better than... So the impact of amendment we have dealt with, so I don't have to waste your time on that. Now we come to the other amendments, the multiple year data. What used to happen, most of the firms in some difficulties, because you have got the data of the year, there is a downturn of an economy. 2008 was a downturn world over. Impact was a downturn on Indian businesses as well. 2009, 10, it takes some time to 2007's impact was continuing. When the impact of the downturn of economy takes place, the profitability is bound to be impacted. Your business is at a low ebb. The profits will be low. You will be competing with a huge number of companies. So you will try to sustain yourself by reducing the price margins and the profit margins. Third-party profit margin gets reduced, so obviously your profit margin within the associated enterprise also have to come down. So in such situation, to use one particular year's data was really becoming an aberration. So what people used to do is that the business cycle is generally for 2 to 3 years. So we will use the business cycle for 2 to 3 years and then report the transactions taking an average of 2 to 3 years multi-years data. We'll take the data of 1 year, 2 year, 3 year and then take an average out of that and then work out the arm's length price which the competitors have charged, peer group have charged. And for that purpose, instead of using 1 year data and finding it out what are comparables, you use multi-years data, find out comparables and make an average of that and report. The department disputed that. He says law does not permit that. Our rule 10B does not permit that. It says 1 year, single year data. Unless you substantiate that circumstances are such that you are required to use more than 1 year's data, and there also you can use for 2 years data. This was genuinely causing difficulties because this was not in tune with the theoretical science of the transfer pricing which is getting developed, which was developed in the world. First of all, I always been saying that the transfer pricing, the way in which it is developed, is nothing but a theoretical exercise. All these 5 methods, as if sacrosanct, you are going to give. If all the 5 methods are not giving you the same result, how can they be scientific? That is the first issue. But nevertheless, these are the methods which have been followed now world over, like a blindly people are following. So if that method, those methods are required to be followed, at least there should be some room or some scope to defend your transfer pricing. And therefore that defense was multiple year data. Indian regulation did not permit that. But our finance minister, our representations which were going every year, and at times I have seen the representation we have made in the last year this year I was before the finance ministry saying that this was a representation. He says this was already there last year. We will not consider it. You are not considered. We considered last year, we have overruled it. We don't want to do it. At least something has happened this year. They have accepted that we will go by multiple year data and instead of restricting the use for single years data only. The revenue authorities were hell-bent on accepting 1 year data or converting your result into 1 year data, and the tribunal also have number of cases did not accept this contention. Now the finance minister has proposed an amendment. I have not yet seen the color of that amendment because no notification has yet been issued. This is provided also that where more than one price is determined by most appropriate method, arm's length prices in relation to an international transactions or a specified domestic transactions undertaken on or after 1st April 2014 shall be computed having regard to the methods as may be prescribed, and accordingly the first and second proviso in section 92C will not apply. 92C will not apply. So 92C first and second proviso was talking about single year data, and therefore the application of those provisions have gone. But what is coming in has not yet been notified. So this is one problem, but nevertheless what I suspect and what I believe, the international practice on this subject, what is international practice? Interquartile range, statistical mean which we call. We take the sample size, eliminate the top 25 examples and eliminate below 25 examples and take a range interquartile in between and then make an average of that. That is more scientific. This is what people say. Aberrations will always be there. then how do you take the data of all the range? That it all depends upon that. You take accordingly, all the changes you go on doing that, it will happen. So you will be able to tally the answer. So this was one accepted principle world over, has been accepted now in India, and that is what I believe possibly because of that litigation on that account would reduce. And I believe it is a welcome change. If you look at the practices world over on account of this interquartile range, multi-year data to be used, the countries have regulations. Australia allows 3 to 5 years data. China allows 2 to 3 years data. 2 out of 3 years data. Sorry, UK allows 3 out of 5 years data, and US allows 2 out of 3 years data. And then you are allowed to take an average out of that. So therefore, these are the good practices India has also adopted, will be adopting. Let's hope that this will resolve some of the problems. The transfer pricing officer now is entitled to initiate penalties under section 271G, which I mentioned in the earlier part of the speech. Nothing so great I can explain about it. But now the thing is, you are subject to the issuance of threatening notice of transfer pricing at 3 levels. Transfer pricing officer, if he misses, officer can do that. Or CIT appeal. Of course, we will challenge it appropriately. In the event now, if the transfer pricing officer has not initiated, one can challenge saying that it ought to have been done at that level and not the subsequent. What are the circumstances leading to a facts are not known to the assessing officer, so how can you do that? Advanced pricing arrangement, the amendment, which is a welcome amendment here, when advanced pricing arrangement were introduced in the Income Tax Act in 2012, it was introduced that once you make an application to the authority and they approve the transaction, of course the process is quite long drawn, once they approve the transactions, then the transaction will have effect of 5 years. The transaction will have effect of 5 years. So advanced pricing arrangement will be allowed for next 5 years. You have a peaceful life. What they have done this year is the approval of the transactions of advanced pricing arrangement can roll back even for the earlier 4 years. How it is going to work in the real life, I do not know. Still, as on today, that it is difficult to guess anything. If the assessments have been concluded, matters are pending before the CIT, matters are pending before the DRP, matters are pending before the tribunal, will the rollback provisions will allow you the same effect and the appeals will be withdrawn? It has to be seen, necessary amendments in the law has to be made out. Those amendments have not been made out. So these are the changes. I think the BCA would have an opportunity to make a presentation to the budgetary authorities. Right now, the process is on. APA, how the rollback will be implemented, that also, if we can think about the mechanism, we should write to the authorities so that we can work out on that. If you look at the rollback provisions, Australia permits rollback, China permits rollback, Japan permits rollback, Singapore permits rollback, and one sec. And US and UK also permits rollback. But US and UK say there is no statutory period prescribed in the regulation. They say we may consider rollback. We will allow rollback. So that is a good thing. And therefore, accordingly, the provisions are welcome change in my opinion. Whatever it may be, at least the change of mind has taken place. That itself is a good beginning in this country. As all of you know, that APA provisions are one of the friendly provisions. When you make an application, you can make an application to the APA authority without name basis, anonymous. You can have a pre-filing discussion with the APA authority before filing an application, proper application with a proper fees. Fees is very high, 20 lakhs of rupees. But you can go with them, go discuss with them and make an application. They will, once having gone through you find that there is some sense of feeling in your favor likely to be, make an application. And thereafter take up the matter further. What happens is once the APA application is made, the APA authority make a prima facie discussion with you, make a detailed inquiry with you, and then they come to your site for inspection and discussion. They will look at various facts and circumstances of your case, and then they will decide the APA. despite the fact that in the first year we have 147 applications, second year 240 applications made, so far only 4 or 5 applications have been disposed of. All of them are unilateral APA. Unilateral APA, I can give a relief on my behalf, no issue. But bilateral APA, you have to take consent of the competent authority of the other country. And both must concur. The effect of that APA, bilateral APA, is so significant that if the tax officer here makes an adjustment, we agree for that adjustment. The other country is party to this and they are bound to give you tax refund in that country. The profit which has been increased in this country on account of the transfer pricing adjustment, agreed adjustment, to that extent there will be a downward adjustment in the other country automatically. And that much tax if you already paid, you will get a refund. So you as a businessman is better off. You are not worse off. You are equally, whatever tax you have paid here will be accepted and whatever tax you have paid there you will be refunded. Either of the country gets a share of their tax. So this is one welcome provision of the APA, but the bilateral APA, so far I have not heard anything. The discussion, very interestingly, when I discussed with the competent authority, he said, only 6 or 7 tax treaties of India has bilateral provisions of tax treaty. The corresponding adjustment, the second country making an adjustment is known as a corresponding adjustment. You have made an adjustment, correspondingly they will make a downward adjustment. That such provisions exist in Article 9.2 or 9.3 of the tax treaty India has with only 7 or 8 countries. 6 countries was my information, but maybe 6 or now recently new treaties they have signed, so the policy shift is taking place. But none of the big countries, Germany does not have such provision. So these provisions are coming in the way of making an APA, bilateral APA. These are the problems. Anyway, the time will resolve the problem. Possibly such is a case where the country should take a unilateral decision that we will negotiate bilateral APA irrespective of the tax treaty provisions, because there are so many changes which we have made in our domestic law which has overridden the tax treaties adversely. Why don't you do a favorable? The other countries' competent authority in any case will have to come forward. The other countries believe that you don't need a provision for bilateral APA in your tax treaty. But India has taken rightly or wrongly a position that we will do a bilateral APA only when the tax treaty permits that. Klaus Vogel's book, if you refer, it also says you don't need in bilateral treaty provisions to make a bilateral APA. Safe harbor rules, as I said to you, they are so unsafe that you don't need to apply the safe harbor rules. Look at software development service, the government wants 20% profit. I can understand big companies having a 20% profit is okay, understandable, IBM would have. But such companies, there is a limit. Only those companies can adopt safe harbor whose turnover is less than 5 billion. So big companies are out. So exceeding 5 billion turnover, 22% margin. So if those companies have 22% margin, why this plug is going? Power. The 22% is the minimum safe harbor norm. KPO 25% safe harbor norm. R&D activities 30% safe harbor. I can understand, those all understand. But look at the guarantees and intragroup loans. Intragroup loan, they say SBI base rate plus 1.5%. It means if you have given loan to your subsidiary company, you ought to charge an interest of 11.5% minimum. In an international 10%, if it is a base rate is a 10%, your interest must be at 11.5%. How can you make a transaction with a foreign subsidiary at an Indian rate of interest, when the foreign subsidiary is in a position to take the borrowing in that country at a much lower rate of interest? So therefore the safe harbor possibly is designed with an ulterior motive that not to adopt the safe harbor by anybody. Same is the case, look at the corporate guarantee, 2%. If the guarantee is less than 1 billion, and if the guarantee is more than 1 billion, 1.75%. I have number of tribunal decisions which have come up where they have accepted the guarantee rate as low as 0.3%, 0.2%, 0.18%. And we have a very interesting tribunal decision of the Delhi, Airtel, Bharti Airtel, which says corporate guarantee is not a transaction at all, pre-amendment and post-amendment. Because it is not having an impact on profit, loss, assets and liabilities, today or tomorrow, future. Unless the guarantee is invoked, at that time possibly there will be impact. Till the guarantee is invoked, there will be no impact on the profit, loss, assets and contingently also. And it is a contingent and therefore it is not a transaction. And is not required to be made an adjustment on account of this differential guarantee rate. Interesting decision. I see quite a good logic, but the logic apart from that, the logic which was given by the tribunal was there is something called as a shareholders function and there is something called as a genuine commercial function. If it is my own responsibility as the owner of the subsidiary company to have funded that subsidiary at a full market, at full capital, then that company would have not taken any borrowings or not taken any the guarantee from you, from the parent. Because I have not funded that company properly and adequately, I am required to give guarantee, and therefore this is purely out of the shareholders function. And if it is for a shareholders function, how can you expect to charge a subsidiary company? You can't charge it. So therefore one has to now create a line of argument, and this has been an internationally accepted transfer pricing explanation. Look at this OECD's recent draft on intragroup transactions. They have also recognized this and they have also explained. Look at the, of course, United Nations draft is coming up next year. We have already worked on that new draft of intragroup services. And where also we are accepting this position, we are laying down the guidelines that shareholders function is not expected to be charged for. And if it is a purely my function as my responsibility to contribute the capital of the subsidiary company, how do I expect the company to charge? Now let me give an example. I have a Singapore subsidiary. I am a mining business. I am in a mining business. I have a Singapore subsidiary. I have created with a view to construct ships, so that I can transport my mining material quickly and swiftly and at a much cheaper cost. I make ultimately more profit. With a view to construct the ship, I require money. With a view to take cheaper money, I have given corporate guarantees to the bank in Singapore. Bank in Singapore have financed the company at an international lending rate which are much lower. All contractors are international companies, so the hard currency payment also could be made out of those currencies obtained by the loan. And therefore, I started constructing the ship. Ship is yet to come into existence. My business is yet to commence. I have just given a guarantee. Am I expected to charge? I have not adequately capitalized that subsidiary. The capital of that company is $1. Let's assume. Can I charge the guarantee? Where from that company will get the money to pay my guarantee? They will ask finance parent only to adequately capitalize, and out of that only you take money back. I think this was really too much. Really aberration of the transfer pricing regulation. But maybe, it may not be aberration, because if the transaction is not explained in the manner, possibly it could result into the similar adjustment. That was one of the observation I felt on the safe harbor rule, which was, in my opinion, is quite a draconian as far as safe harbor. However, certain safe harbor percentages are quite useful in arguing your appeals. In automobile industry, this is auto component industry 12% profit. The companies are charging much higher. Say cost plus arrangement is 15%. You can always say your safe harbor, and the officer says no, it should have been 22%. Now one can argue it out. Safe harbor rule permits you 12%. I have charged 15%. How do you expect me to charge more than that? So therefore you can argue out those issues before DRP or the appeals. Though there is some clarification on the guarantees and counter guarantees, we argued the matter before a DRP. I said, if you have this safe harbor on interest and counter guarantees and guarantees domestically, if I lend the money to my subsidiaries, will you accept this rate if my parent has given guarantee to the Indian company? Or if my parent has lent me the money, you will apply SBI rate and interest rate at that percentage, I will be able to pay the money on account of interest. He says, no, you are governed by the ECB rules in that case, the Reserve Bank of India's regulations. So these are the issues, these are the major issues. We want to have one-way traffic. We don't want to adopt the second way. We are making the regulations without even applying mind, without even thinking what will be the impact on a reverse transactions in India. And companies have started contending in this manner now, foreign companies. And the money is going out of the guarantees, etc., would be out of the without payment of any tax in India. So therefore, these are the issues. And there are a number of other instruments other than the bank loan or the loan, debentures, etc. There is no guidance. Letter of comfort now constitute whether guarantee includes letter of comfort is an issue. Guarantee requires it presupposes financial obligation you have on contingencies required to be paid to the foreigner, for the person, to the person to whom you are given a guarantee. But letter of comfort does not have financial obligation. In fact, it is not a guarantee at all. And at times, banks accept letter of comfort. They say, okay, as long as our loan continues, your holding will not disturb. You will not disturb your holding. You will be the owner of this company. And we recognize your reputation and we will give you the loan. If that be the case, the department has even made an adjustment on account of that. So that is really an issue which requires serious consideration, whether to have these sort of regulations in our country. I will not speak much on the safe harbor. There are a lot of issues which we can talk about. Domestic transfer pricing. The only few issues I'll just deal with you. The time doesn't permit me to take you everything. The presentation, of course, does not have anything on the domestic transfer pricing. Purposely I have not kept, because I was quite hopeful till today that we will have safe harbor on the domestic transfer pricing. I was told that the safe harbor, which the finance minister has mentioned in his finance bill, while moving the finance bill, he said they will be simplified. Based on the directions were given to the government, to the CBDT to work out those safe harbors. What are those safe harbors? There are 3 safe harbors which are under the pipeline, which are under discussion. 2 at least are quite sure. For example, 40A2 applies to a cooperative society between member and the company, member and the society. And there would be a model of the power sector companies where also people become member of that power distribution companies in some of the states. So any payment made by a member to society and vice versa, sugar cooperative, vice versa also, are subject to 40A2. And if that be the case, then it is a really too much of an extension of the provisions. So I was told that these provisions will be relaxed in such cases totally. And also I was told, and provided of course there are some conditions that both are paying taxes at proper rate. Also I was told that the 2 domestic companies, when they enter into a transaction with each other, and both the companies are paying taxes at the full rate, 30%, at full rate, both same rate at which they are paying, then the transaction between 2 of them are deemed to be at arm's length. It is a fact, because whether you transfer profit from one entity to another, there also you pay the same. There is no loss of revenue as far as government is concerned. And we at a Bombay Chartered Accountants Society and the Institute of Chartered Accountants of India made strong representation on that, and that was considered very favorably. But so far we have not heard anything. So considered only favorably. Operation is successful. Patient has died. That is the situation. Chairman, sir, 2-3 minutes or some time for questions. You want me to deal with questions? Okay, fine. Okay. Now, domestic transfer pricing, some of the provisions, if you look at particularly in the real estate sector, huge difficulties. Joint venture transactions, genuine, sometimes you can get out of the domestic transfer pricing, you structure your transaction in a manner, it is not possible to apply these provisions appropriately. It is possible to avoid application of these provisions altogether. Certain transactions, genuine difficulties. Last year, of course, we have done the reporting, and the reporting is done whatever is the basis which you have adopted, directors' remuneration and all sort of transactions which we have gone through the difficult tests. We continue to go through the test because we have no other clarifications on the subject from the government. Only whatever clarifications, whatever the advantage you can take is of the company law. You can take, now company law applies equally both to the private and public limited companies, amended Companies Act. One can adopt those regulations if the board resolution has adopted. If the shareholders have approved the transactions, it has to be arm's length. This will be your line of argument which you have. Apart from the company, apart from the domestic transfer pricing regulations, clause 49 of the stock exchange listing agreement, all the listed companies are now required to adopt arm's length price. The transactions with related parties are at arm's length under the board in a quarterly board meeting and get it approval by the audit committee. I think this is a major challenge, and therefore companies will have to now gear up, asking their auditors or any expert who is doing the transfer pricing work to certify that the transactions are at arm's length, and we at a profession will have to gear up to render this service to the clients on a very frequent basis, quarterly basis, so that at the end of the year it is easier for you to compile the information. And this is an additional opportunity for the chartered accountants to undertake such an exercise. To what extent is a free from liability, I can't say, but nevertheless is an opportunity. I was told when I represented to the institute's president, I said, why do you need a domestic transfer pricing? First of all, why don't you make a representation to the government of India? Genuinely, we don't need domestic transfer pricing because 40A2 already exists in the law. Chartered accountants have been certifying. So why in the tax audit report, why do you need us? This is a big opportunity for our chartered accountant fraternity to certify. I said, but at what cost? Anyway, friends, at times, even if you don't like, things are existence, so we have to live with it. Thank you very much for listening me patiently. In the limited time I could do, whatever limited explanation I could do, I tried to do it. Thank you very much.
Thank you, Sam, for very lucidly explaining various recent developments as well as issues and controversies that are faced. I think your insights that you have shared are invaluable. We don't have much time for question and answers, and I request Vivek to propose a very little. I request all of you to just bear for a couple of minutes as courtesy to our learned speaker, and Vivek will propose very well. Thanks. Before that, few announcements.
Yeah, first of all, on the 8th of November, there is a tax audit seminar at the same venue, and the committee, the group is going to release a draft tax audit report, so recommended that all of us attend on this for the full day seminar on tax audit. So, Mr. Speaker, Mr. T.P. Ostwal, Nitin, and Raman, thanks for a fantastic subject that you covered today, Mr. Ostwal. We had a movie that got released in the festival season, so there was a story that did not take off and the star was faded. As opposed to that, we have a subject which was the very fact that there are so many attendees over here means the subject is very endearing. But more than that, we have a speaker who is also a star who has done a fantastic job of covering transfer pricing. So on behalf of all of us over here, may I propose a very hearty vote of thanks which all of you can carry with a very loud applause. Thank you, Mr. Ostwal.